Hey everyone, welcome to Happy Friday. I'm Phil Hodgen, and welcome to the Hodgen Law PC International Tax Lunch. We do this almost every month on the last Friday of the month at noon Pacific time. And the ones we skip are because they're filing deadlines that collide with when we want to do this. So everybody's going to be preparing tax returns instead of watching videos. Anyway, listen in online just like you're doing right now, which is live. See, that's me banging on the table, or watch it on later. We post it on YouTube. This month's topic is Form 5471 exceptions and reduced filing burdens, or as I like to say, do no work, do less work, or let somebody else do the work, because anybody who's on there knows how much work a Form 5471 is. This is where we are in the series that we're doing with CalCPA. And thank you very much, CalCPA, for indulging me for putting in a whole year's worth of 5471 stuff on the calendar for them. So we're at the wrapping up the end of discussing who's the filer for Form 5471. And next month, we're going to start launching into the income that flows through to a U.S. shareholder of a controlled foreign corporation. Table of contents, because why not? And here we go. So how we organize this thing? I'm not going to go 1, 2, 3, 4, 5 because I'm not that anal retentive. I am, but not that bad. And instead I'm going to group it in categories by the code section that triggers the filing requirement and therefore triggers the exceptions that exist. So categories 1, 4, and 5 are the filing requirement is all triggered by section 6038. So we're going to deal with them in sequence. And I'm going to start with category 5 because that's the real pig of the whole show because of what happened in 2017 Tax Cuts and Jobs Act created a giant mess. So we're going to deal with that. It spawned a couple of exceptions and it spawned some less work categories. So we're going to deal with all of the big mess with category 5. Category 1 is almost like category 5 with a few added wrinkles. And then category 4 is easy. Categories 2 and 3, these are the event triggered filing requirements. Acquisition of stock, disposition of stock, becoming a U.S. resident, stuff like that. And they're both based on section 6046. And so they share a lot of commonality as well. And I'm going to deal with those later. So as I said in the title, I think of this in terms of no work, less work, and somebody else does the work. And as you go through here, you're going to see there are some situations where you don't have to do anything and you're home free. You're the master of your own fate. And if you create a penalty problem, it's your own problem. There are other situations where you're shoehorning off other people. And if they screw up, then you pay the penalty too. So you'll just watch for this. Anyway, this is think of it this way. And of course, no work is better than less work. And somebody else doing the work is just fine as long as they're diligent. So let's start with category 5. And as I suggested, this whole thing, the whole hour we're doing here about exceptions and reduced filing requirements, I've got to say that the instructions for Form 5471 are really good on this. They lay it out. Here's category 1. Here's who has to file. And here are all the applicable exceptions, category 2, 3, 4, 5 in sequence. So you're going to find they are pretty good. Every now and again, you're going to have to dig in deep into the regs or something to find out if there's something special in your case. But for the most part, the instructions are going to carry you through or at least get you intelligent enough so you can spot the problems, except for the 2017 Tax Cuts and Jobs Act, which impacted categories 1 and 5. And so we're going to deal now with the first exception that is a byproduct of the 2017 Tax Cuts and Jobs Act. And the specific reference, the authority that you're going to use is Notice 2018-13. And a Section 502 specifically gives you the hall pass that you don't have to file a Form 5471. So here's the whole thing. On the right, I've just sort of given you an excerpt out of the instructions. That's what it says. And it also gives you the citation to the notice. And on the left, we have these two weird new ideas that were introduced by Notice 2018-13 and what we're going to deal with next, which is a revenue procedure, RevProc 2019-40. So a little bit of background, and you'll see this again and again. But in the good old days before 2017, there is this thing called downward attribution where a corporation is deemed to own all of the stock that its shareholder owns. And in the good old days before 2017, the rule was we're not going to apply downward attribution from a foreign person to a domestic person. And this is just a way to not accidentally create some category 5 filers where they really had nothing to report. It was just sort of an accident to ownership that triggered the filing requirement. Well, Congress blew that thing out of the water by specifically repealing Section 958B4, which was the one that said don't attribute ownership downward from a foreign person to a domestic person. And the collateral damage ensued. They accidentally created a whole bunch of U.S. people who now became U.S. shareholders with a Category 5 filing requirement where they didn't have it before. And these people, furthermore, frequently had no ability to extract financial data out of the foreign corporation for which they were supposed to prepare Form 5471. So they're put in an impossible position. They've got a filing requirement and no access to data. So what are you going to do? Pay your $10,000 penalty, please. So Congress may be stupid, but the IRS is not. So the IRS looked at this and said, oh, this is kind of dumb. And so we're going to craft some administrative exceptions. And the first one was this one in Notice 28-13. And it said, if this foreign corporation, after you're done with all of the constructive ownership rules and you figured, oops, I've got a Category 5 filing, doesn't have anyone who is a quotes Section 958A U.S. shareholder, and this foreign corporation is a foreign controlled CFC, and both of these I'm going to tell you what they are and defined, then you don't have to file. And so what this is going to pick up is if you only have deemed share ownership in a foreign corporation because of the constructive ownership rules, you don't have direct share ownership in the corporation. You don't have indirect, like I own a holding company, the holding company owns stock in a foreign corporation. So those are direct and indirect. If you have none of that, it's just constructive, then you don't have to file at all. The instructions are silent on whether you need to attach a statement claiming the right to take this Notice 2018-13 Section 502 exception or not, but there you are. You've attached a statement or not, depending on your Dirty Harry theory of tax compliance. Do you feel lucky, punk? So let me just show how it works. This is the good old days before the Tax Cut and Job Act. You have a very simple kind of structure here. Foreign parent corporation owns one foreign subsidiary and one owns one U.S. subsidiary. And the question is, does subsidiary A, the blue box, have a Form 5471 Category 5 filing requirement in this scenario? Well, the first thing you have to do when you're asking yourself a question like that is, does subsidiary A own stock in subsidiary B, the foreign corporation? The answer is yes, it does, because of the attribution rules. So Section 958B, like boy, says in a circumstance like this, apply the attribution rules of Section 318 to figure out if you are a constructive shareholder. Well, Section 318A3, capital C in this case, says that a foreign corporation, if it's owned 50% or more by a foreign person, is deemed to own all of the stock that that foreign person owns, or domestic person for that example. So simple example. Here I sit. This law firm is an S corporation. I own more than 50% of the stock. And also over in Schwab, I happen to own some Microsoft stock. The downward attribution rules of Section 318A3C say that my law firm S Corporation is a constructive shareholder in Microsoft. That is a very simplistic example of downward attribution. Of course, and there's a million reasons why the law firm, the S Corporation, doesn't have to worry about reporting Microsoft stock and dividends and all of that, but that's how it works. Before, you can see I've got the red arrow saying there is no downward attribution despite Section 318A3C because of the prohibition in Section 958B4, now repealed. So that's why in the good old days, subsidiary A did not have a Category 5 filing requirement. Today, how it works. Section 958B4, that firewall against downward attribution from a foreign person, has been obliterated. It's gone. So now we just apply the plain, ordinary, vanilla flavored Section 318A3C. Hey, presto, subsidiary A is deemed to be the constructive shareholder of 100% of subsidiary B. Now you look at the definition of a United States shareholder, which is Section 951B, and it says, well, if you own 10% or more of the stock of a foreign corporation, either directly, indirectly, or constructively, then you are a, quotes, United States shareholder, close quotes. So now we know for a fact that subsidiary A is a constructive shareholder and a U.S. shareholder of subsidiary B. We also know that subsidiary B is a CFC because Section 957A says if a U.S. shareholder, all the U.S. shareholders put together own more than 50% of the stock, constructively, directly, indirectly, then it's a CFC, which it is because 100% of the stock is owned constructively by subsidiary A. So now subsidiary A has a Category 5 filing requirement, even though there's no economic possibility of flow through of any kind of income to subsidiary A. So it's kind of dumb, isn't it? A bunch of paperwork gratuitously that will never collect a dollar of income for revenue for the United States Treasury. So this is now IRS comes along with the notice and says, okay, we're going to give you a hall pass. You don't have to be a Category 5 filer. You don't have to do anything. And so here's how it works. We say, we've got this situation, but if you see the green arrow on the left, if you are a U.S. shareholder, but you're not a special kind of U.S. shareholder, you're not a Section 958 open parentheses, little a, close parentheses shareholder, then you've got a no filing requirement at all. So what is a Section 958A U.S. shareholder? That means direct ownership or indirect ownership through a foreign entity. And since neither of those are true, then we can use the exception here, notice 2018-13. And I think in most cases, I mean, I'm not going to guess on statistics, but I'm going to say with a high probability, when you have a domestic subsidiary of a foreign corporation and it has a whole array and a little pyramid of stock, of foreign subsidiaries all over the world. At first glance, I think you're going to find that subsidiary A has a category 5 filing requirement. And at second glance, I think notice 28-13 is going to solve a lot of your pain. I mean, over the last month, I had back and forth with one of the listeners, Richard, in upstate New York, in a situation like this, where there was many more subsidiaries than that. And indeed, that's how it happened. And it's just a normal kind of business structure. And 28-13, Section 502 was the one that worked and eliminated the 5471 problem for subsidiary A for him. Now, here's an example of where the Section 5.02 exception fails. Remember, it said that you can only use this if there is no Section 958A U.S. shareholder. Well, here, make pretend the little star is some unrelated U.S. person that owns 10% of subsidiary B. This all by itself is going to eliminate the possibility of using 2018-13. On the other hand, just playing with the numbers a bit, if this unrelated U.S. person owned 5%, then the unrelated U.S. person would not be a quotes U.S. shareholder, close quotes, and therefore you could still use the notice 2018-13 exception. So this really reinforces the importance of getting a complete and accurate structure diagram, including the share ownership, how much is owned by anybody, and who that anybody is, U.S. person, not a U.S. person, that sort of thing. So I can't tell you how many structure diagrams I've received that are visibly incomplete. They say 60% owned by parent corporation. I say, where's the other 40%? Don't do that. So that's the 2018-13 exception. I like it because it solves a lot of practical problems and it takes a lot of work off your desk. Let's move on to the next exception that is brand new because of the downward attribution problems that Congress created in 2017. And this one comes from a revenue procedure that is much longer and more involved than the notice we just looked at. Revenue Procedure 2019-40. So here is the exception, and it's in section 8.04. So here's a situation where you remember that diagram I just did with the star, unrelated U.S. person. Now we have a U.S. shareholder that has 10%, and the notice 2018-13 exception doesn't apply. Well, here we've got one, but maybe we have a possibility for getting the category 5 filing requirement eliminated anyway, even though that unrelated U.S. person with 10% exists. So on the right, you can see the quote from the instructions. Number one, the foreign corporation is a CFC. Number two, I just looked over at my other laptop and I noticed the chat's full. By the way, we are going to do a half-hour Q&A afterwards on a separate Zoom thing. Rachel will be throwing the link in the chat field if she hasn't already, so you can go log into the Zoom. So we'll start that shortly after this ends, giving me a few minutes for a potty break. And I'll try and answer as many questions as I can there. So here we have this idea, quotes, foreign controlled CFC. What's that? We'll find out in a second. And we say, you yourself, the one who is seeking an exception to 5471 filing, do not own any stock within the meaning of Section 958A, which means direct or indirect ownership. And this third idea, you're not related, as defined in that code section, to the foreign controlled CFC. So now we have three brand new concepts in federal international tax law spawned administratively because Congress was asleep at the wheel in 2017. But I'm not bitter and I do not judge. So let's look at this idea of foreign controlled CFC. First, we look at the noun CFC, that's what you are. And then we look at the adjective foreign controlled. Well, a controlled foreign corporation, the CFC, incidentally, in the notice, they call it a foreign controlled CFC. They never extend that acronym to its full meaning, because if they did, they would realize how silly they sounded. Imagine writing a new definition, which is a foreign controlled foreign corporation. You just sound like a midwit if you did that. So foreign controlled CFC, here's how you figure it out. It's really simple. You take the current law and you figure out the stock ownership applying today's attribution rules, which allow attribution from a foreign person. Then, and you come up with an answer. Is it a CFC? Yes or no? Next, you use the attribution rules the way they used to be before 2017, where attribution from a foreign person was disallowed. Is it a CFC under that scenario? So then you say, well, if it's a CFC today, but it wouldn't have been a CFC before the Tax Cuts and Jobs Act, then it's a foreign controlled CFC. And it makes sense. I mean, the reason is that you accidentally created, by downward attribution from a foreign person, enough make-believe US shareholders, constructive owners of stock from a foreign person, so that more than 50% of the stock of that CFC is owned. So only because of foreign stock ownership have you been pushed over that 50% mark. And that is a foreign controlled CFC as defined for the category 5 purposes. So this is the beginning of your clue about this category 5 ABC and categories 1A, 1B, 1C. This is one of the critical components, and we'll come back to those in a little while. So here, I'm going to walk you through the steps. Again, the same little diagram as before. Are you a CFC under the current rules? The answer is yes. We apply the current rules. We attribute stock ownership downward from a foreign person to subsidiary A, a domestic person. So now we know it's a CFC under today's rules. Then we apply the attribution rules the way things was one day, where there is no downward attribution from a foreign person. And we realize that no, this would not be a CFC if downward attribution was prohibited from parent corporation. So we have a difference. Now, one set of analysis makes it a CFC, the other one doesn't. So as a consequence, we conclude, because it's a CFC only because of constructive ownership from the foreign person, we have subsidiary B is a foreign controlled CFC, and subsidiary A is a United States shareholder of subsidiary B. So now we have the beginnings of how we can unravel the mysteries of not only this exception, but also the categories 5A, 5B, 5C. So the meaning of section 958A shareholder is you are a US shareholder if you own 10% or more of the stock. But you are a section 958A. Now, remember, we're talking about nouns and adjectives. Now we're talking about the adjective phrase section 958A. And you must own no stock within the definition of section 958A. So even if you own one share directly, like you're a director of the corporation, and in order to be a director under foreign country law, you have to be a shareholder, so you hold a symbolic single share. You're SOOL for this exception. So you have to have none whatsoever, so all of the shareholdings are because of section 958B, which is the constructive ownership rules. The third little element here that you need in order to qualify for the section, the RevProc 2019-40 exception to filing. So this wipes out the Category 5 filing entirely. This idea of related, are you related to the CFC? And so the 954D3 is where they told you to go to find what does related mean. And it's all about control, and control means owning more than 50% of the company. So an individual who controls, we don't have that. Entities, partnerships, estates, trusts, or corporations that control the CFC or the CFC controls them, those are related. And then the one that I'm going to show you in the next slide is you have a control by the same person. So a single shareholder controls both, of the two corporations in my example. So this is not dead on for the exception here, but I wanted to use the same picture that you're used to already to show you how this common control concept works. You say, well, parent corporation owns more than 50% of subsidiary A, owns more than 50% of subsidiary B. Therefore, parent controls both of them. Therefore, subsidiary A and subsidiary B are under common control. Therefore, those two companies are related, and therefore shareholder, subsidiary A by constructive ownership, is related to foreign controlled CFC, subsidiary B. So there's a related. That's how it works. Here is an example of how you can get an unrelated constructive U.S. shareholder. So this is the type of beast that is permitted to use the RevProc exception here. And I've taken this example straight from the examples in example 3 in the RevProc, and I made it pretty. So what we're trying to do is, you see down in the bottom right, we have DPS, which is a domestic partnership. And we're trying to figure out whether DPS, the domestic partnership, has a Category 5 filing requirement with respect to FJV, the foreign subsidiary. Up in the top left-hand corner, you can see UPS, a domestic subsidiary corporation, owns 10% of FJV. So that tells us right off that we cannot use the Notice 2018-13 exception to filing because we have a direct U.S. shareholder. So we are going to either fit ourselves within RevProc 2019-40 Section 804, that exception, or you've got a Form 5471 filing requirement for DPS. So here's how it goes. The green arrow labeled number 1, this shows attribution of ownership of stock by way of FPS. So FPS is the foreign parent, similar to my example before. And constructive ownership says that if the foreign shareholder owns 50% or more of the foreign subsidiary, then the domestic person down below is going to be deemed to own all of the stock that the foreign owner at the top owns. It's different in this case because I've got a domestic partnership, or the example had a domestic partnership. And we have a 5% ownership in the domestic partnership by the foreign corporation. The rule for downward attribution from partnerships doesn't have any sort of floor requirement before attribution happens. It happens from day one. Unlike with corporations where you have to have 50% or more, even 1% ownership as a partner will be sufficient to cause attribution to the partnership. So therefore, under number 1, domestic partnership is considered to own 90% of FJV, the foreign corporation, the subsidiary. So far, we've figured out that we have a U.S. shareholder, domestic partnership, and we know so far that FJV is a controlled foreign corporation because a single US shareholder owns 90% of FJV. Now we come to the related question where you have to prove that the two companies are unrelated. So DPS is not related to FJV. And the relationship, remember in my previous example, I showed the common ownership. Well, the difference here is that the downward attribution rules for Section 318 do not apply at all for determining related party status. So you don't have to worry about, are we going to imply a relationship by way of the common shareholder? So as a result of that, DPS is going to be unrelated. And if you're confused now, welcome to the club. It probably took me about 3 hours of just reading and looking and poking and prodding until I finally started to get the related party stuff here. So none of this comes fast to me. I hope if it comes fast to you, God bless you. But what I want to point out here is the bizarre way in which the collateral damage wave of problems from the simple repeal of 958B4 just cascades downstream. And now we have a situation where they're telling us apply Section 318A3 for downward attribution from foreign people. Don't apply it from foreign people. Don't apply it at all. It gets really, really touchy. And I'm telling you all of this and being redundant and obvious because I'm saying that if you have a 5471 filing situation like this, and you have a bit of a manky holding structure, unless you're diving deep into the regs and the RevProc here and the notice, I think you're as likely as not to come to a wrong conclusion. It's just that weird. And I don't think human brains can possibly keep all of the operating rules in short-term memory sufficient to make it work. At least I can't. So what I'm telling you here is go read the example, follow through. The example will also tell you why UPS is okay for not filing. The top left-hand corner one. But I'm also telling you just in a broad sense, if you're relying on about 7 minutes of me babbling and staring at a screen to get smart, don't do that. All right. Let's move away from the problems of downward attribution and all of that garbage that were caused, and let's move into the normal stuff. These are exceptions that have existed since the beginning of time. And so if you've been doing Form 5471s for a while, you've seen these many, many times. Category 5, constructive ownership of stock from a non-resident alien. You have constructive ownership from a non-resident alien. You don't own direct or indirect interest in the foreign corporation. You don't have to file. Simple situation. Husband and wife. Wife owns 100% of the stock of foreign corporation. The Section 318 attribution rules say attribution between spouses. Therefore, you constructively own 100% of the stock, but you don't have a direct or indirect interest. You don't have to file, even though technically you are 100% shareholder under those rules. So that's the first one. The second one that we have, constructive ownership, that's familiar to those of you who've been doing these for a long time, constructive ownership through a U.S. person. Again, we get to the same situation. Let's say husband and wife. Wife owns 100% of the stock of a foreign corporation. Husband owns nothing. What do you do? Well, wife has a filing requirement under Category 5. Husband has pure constructive ownership. As long as wife does the correct filing under Category 5, husband does not have to file. So note that all of a sudden the constructive owner's penalty exposure depends on how diligent the person with the direct ownership is in terms of filing and making things happen, unlike with the non-resident alien. No work. Again, I should really have labeled this slide as rely on somebody else to do all the work. This is a jointly filed Form 5471. This is item H on page one. You just the person preparing the Form 5471 says, I'm filing this on behalf of somebody else. You attach a statement to your tax return. You tell the IRS, hey, somebody else is doing it. You bear the penalty risk if that other person screws up, but via con Dios, and in the situations I'm seeing, typically there is a strong enough either familial or business relationship so that the person actually doing the work is not going to screw up because they're going to feel bad if they do at a bare minimum, and it might cost them some money. Foreign corporations electing domestic status. I just put these here as a bookmark so that if your practice covers foreign sales corporations or captive insurance companies, these are situations where you have a foreign corporation, but it elects domestic status. So a foreign sales corporation files a 1120 FSC. Captive insurance companies elect to be taxed as domestic insurance companies, file 1120. In that case, you don't have to do the Form 5471. Certain exceptions apply. So, yeah, as always, certain exceptions apply, not valid in all states. Let me just one more thing on electing status. There's one thing that might come to mind, if you have foreigners who own U.S. real estate. Let me go back to this slide because this is where I'm talking. And you have a foreign corporation owns U.S. real estate, there is an election you can make under Section 897I that will treat the foreign corporation as a domestic corporation only for FIRPTA purposes, but not for the rest of the code. So this election out of Form 5471 wouldn't work in a situation like that if you had some bizarre situation like U.S. person owns a Bahamian corporation that owns U.S. real estate. I don't know why you do it, but weirder things have happened. I guess I can think of a reason. Someone who was a non-resident alien became a U.S. resident, and therefore, all of a sudden, you got a problem. All right. Let's go on to less work. Let's return to the revenue procedure, and we're looking at categories 5A, 5B, 5C. 5A is the traditional category 5 filing that you know and loved in previous years. 5B and 5C have reduced reporting requirements. And so here you are, just purely based on numbers. You can see that if you can fit yourself into 5B or 5C, you get fewer schedules to prepare, less work to do. Everybody's happy. So that's the general concept. And we're going to look at what does it mean to fit yourself into category 5B or category 5C so you do less work. Here's my handy dandy float. Well, it's a part of my handy dandy category 5 decision tree that I work through when I'm doing projects like this. Above the top of the screen here, there's a whole new part in which you figure out, am I a United States shareholder? Is this a controlled foreign corporation? Can I take advantage of the Notice 2018-13 exception? And assuming all of those are answered the right way, you come to the point we see right here where you say, heavy sigh. I'm a U.S. shareholder of a controlled foreign corporation. Now what? Category 5A, 5B, 5C. And here's how you figure it out. It's a simple, hyperlogic. The first thing we are looking at is, are you a 958A? Remember, that's direct or indirect shareholder. And that's going to tell you one direction or the other. So let's take the far left column. You are a Section 958A shareholder. The next question you have, and it's going to be common for whether you do have direct and indirect ownership or you don't on the right. And if you don't, you're a constructive shareholder. The next thing is we figure out, is this a foreign controlled CFC? And remember, we did that by running the attribution rules two ways, once with attribution from a foreign person and once without attribution from a foreign person. And we decided, for instance, we are going straight down the line. It is a controlled foreign corporation and it is foreign controlled. Then you have 958A U.S. shareholder status in that thing. And then we come to the related question. Remember, we talked about related in the context of Section 954. And you're either going to come to category B or category 5B or 5A, depending on your yes, no answers to those. Then you can see the label of the type of shareholder you are, U.S. shareholder being your noun, Section 958 being one adjective and related being the other one. So if you satisfy I am related, I am a Section 958A U.S. shareholder, then you're a category 5B filer. And then you look at that little table I showed you on the previous slide and it tells you what schedules you need to do. The column on the right, you are a constructive U.S. shareholder. This is identical in meaning to the you are not a Section 95A U.S. shareholder. It means that the only way you own shares in that controlled foreign corporation is because of the constructive rules of Section 958B. So the next thing we go down, we determine it's a foreign controlled CFC. And now we come say yes to that. You are a constructive U.S. shareholder of that's your status. Backing up, the little squares these are your answers, and the diamonds are questions, and the pill-shaped things are conclusions, starts and finishes, just so you know how I set it up. And then finally, we go through the related thing. And you can see with a constructive U.S. shareholder, you're either going to be a category 5C related or no filing requirement at all, unrelated. So this is how the exception we just talked about ties into the whole analysis. Then finally, let's just look down that middle part, the default category. And if you look at the instructions, what it says is, well, if you don't fit into 5B or 5C, you must be a 5A. But there's a little bit more to it than that. Let's look at, again, going back to the 958A U.S. shareholder, meaning you own some stock directly or indirectly. And then we go down and we decide in the diamond that we have a foreign controlled CFC. We say, no, it's not foreign controlled because it was a CFC with the attribution from a foreign person and without the attribution from a foreign person, which means that people who are U.S. persons who own stock directly or indirectly in the CFC own more than 50%. Well, that's a U.S. controlled CFC, and that's like the good old days, right? Real Americans owning more than 50% of the stock of a foreign corporation make it the controlled foreign corporation. So the notice calls that a U.S. controlled CFC. And if you have U.S. shareholders that own stock directly or indirectly in a controlled foreign corporation, guess what? That's like you used to do Form 5471s forever before the 2017 Act. So that's going to be the default category. The other way that you get into the default category is if you are related, or that comes down to that related or unrelated situation. If you are not related to the person, you're going to default to the foreign corporation. You're going to end up in the default category. So It's a bit messy. I hope the diagram, if you follow through when you're sitting down to work at it, just follow through the steps one at a time. And hopefully that will help you put yourself in 5B or 5C, um, and reduce the amount of work that you have to do. Less work, dormant corporations. This has been around forever, since 92, in fact. And the big question is, how dormant is it? And so here are the critical elements. You can look in the RevProc for the explanation, but it's maximum of 5,000 of gross receipts or 5,000 of expenses. Asset value, ignore liabilities, 100 grand or less. Nothing happens, no distributions, share transfers, reorgs, no nothing, didn't conduct business. And your E&P is basically static, except for, if you had a little de minimis income or expense up and down. And if so, you are a dormant foreign corporation, and you can file a very abbreviated Form 5471. And there's the instructions. Basically, it's the top 2/3 of the page, on the first page of Form 5471, and easy peasy, you're done. Less work. Again, we're still in category 5. Trust me, it'll move faster after we get out of category 5. Form 5471 for treaty tiebreakers. So, who qualifies? Someone who is a resident alien for income tax purposes, green card substantial presence test. Someone who is eligible to claim treaty tiebreaker benefits, where two countries, the United States being one of them, claims this person as a resident, and the treaty gives them the tiebreaker in favor of the other country. So they, with the treaty election, become a non-resident of the United States and a resident of the other country. So call those a treaty tiebreaker non-resident. And critical thing number 3, there's nobody else that has to file under categories 1, 4, or 5. So if you have all of that going on, then you can produce some audited financial statements and bolt them to the back of Form 5471 to substitute for a number of the schedules and the reporting requirements for this thing, E&P and balance sheets and stuff like that. And in the interest of time, I'm not going to go through that. But this may be a little bit of a shortcut for you if you have one of these situations. All right, having got out of category 5 and spent a lot of the time, let's move much faster. Category 1 is just like category 5 with 2 exceptions. Category 5 says the kind of corporation you need is a CFC. Category 1 says, yeah, you need a CFC, or you can have any kind of foreign corporation that has a domestic corporation that's a U.S. shareholder. So a different way to get to the type of corporation that triggers category 1. And the second one is a filing exception that we will look at, is that the section 965 earnings and profits go down to 0 on schedule J and P, then you can stop filing category 1. So I assume everybody knows what section 965 was. This, another exciting thing out of the Tax Cuts and Jobs Act. There's a case that is pending in the Supreme Court to rule this as unconstitutional. So God willing, the Supremes will put a bullet through section 965 and create ultimate chaos in the US tax system, because if they put a bullet through section 965, then that implicitly puts a bullet through section 951 cap A, global intangible low taxed income, and subpart F, and everything. So for that reason, I don't think they're going to do it, but it's possible. So here's the exception. You're going to look at Schedule J and Schedule P. So if you don't have any, if you zeroed out the earnings and profits on the previous year, you're going to be fine. I mean, for the year that you zeroed out, you're going to file as category 1 to report it went down to 0, and then you're out. And this makes sense because section 965 just accelerated all of the untaxed earnings and profits that hadn't been repatriated to the United States. So as soon as they got taxed and distributed to the US shareholder, there's no more reason for tracking this on the reporting forms at the IRS level, because all the problems have been solved. So that's why this exception exists. Category 4, this is again the third of the triad under Section 6038. The same rules apply for Category 4, except there are fewer exceptions here as compared to Category 5. Constructive ownership from a U.S. person works the same. Constructive ownership from a non-resident alien works the same. The foreign corporations that elect domestic status works the same. Treaty tiebreaker non-resident works the same. Joint filer works the same. All right, let's get out of Section 6038 and let's hit the last two, which are relatively straightforward. Category 3 and Category 2. And here we have constructive. Are you sensing a trend here? The word constructive should wake up your head and say, ooh, maybe I've got something that will save me a little bit of work. So constructive ownership from a U.S. person, as usual, you have attribution and you don't have any direct ownership in the stock and you don't have to file. Okay. And note, in a second, we're going to talk about the overlap of this specific exception with Category 2. So if you have an acquisition of 10 percentage points or more of the stock of a foreign corporation, this triggers a Category 3 filing requirement for the shareholder. It also triggers a Category 2 filing requirement for a U.S. person who's an officer director to rat on whoever that U.S. shareholder is who just acquired the stock. Well, if the actual U.S. shareholder is excused from filing, you might as well excuse the U.S. shareholder, U.S. officer or director from reporting, and pointing the finger. That guy over there, he got 12% of the stock. Joint filing exception. Again, we've got the same idea where you can file this as an item H thing, and you have less work, but you still have the penalty exposure if that person doesn't do the job as well as they should have. Finally, let's move on to Category 2. Category 2, as I said, this is a U.S. person, human being, a resident or citizen, who is an officer or director of a foreign corporation. That person has an obligation to report acquisitions of stock above certain thresholds. And those thresholds also trigger a reporting requirement for the acquiring U.S. person to file as Category 3. So they go together. So the first one, and this is quite useful in closely held situations, you have somebody acquiring stock of a foreign corporation, and they're a Category 3 filer, and they file. And immediately after the acquisition, 3 or fewer U.S. persons own 95% or more of the stock. So this is the kind of situation where if you're in tune, your brain just remembers 95%. When one of these comes across your desk, odds are, if you don't have a checklist, and you should, you're going to remember this and you're going to apply it. This one is the overlap rule. Remember, we said if the Category 3 filer is excused from filing because they're constructive owner, then the Category 2 person is excused from filing as well for the Form 5471. The joint filing, as usual, you got a couple officers and directors, they can file a joint tax return for 5471. I give you the quoted sentence from the regs because I think there was a comma shortage when they wrote this regulation, and it's fatally ambiguous. But I'm not Mr. Grammar. Much. And then the final way you can do it, if you are a U.S. shareholder, a U.S. person who's an officer or director, and you've got another one, you can give that person power of attorney to file a 5471 on your behalf. So there's that if you want to use it. So let's wrap up here. Here's my decision tree just at the high level. You start with Is there a Form 5471 filing requirement at all? Which means you figure out, am I a US shareholder? Yes, no. Is this a controlled foreign corporation? Yes, no. Once I've figured that out, the next thing is I look for, can I use the dormant foreign corporation exception? And the reason that you look for that early is because all you have to do is look at the balance sheet. You can tell in a second whether this is going to work or not. And then if you can't use that, then you're going to go down to the exceptions that we've talked about over the course of the last 50 minutes. Can I use one of, notice 2018-30? Can I use the RevProc? Can I use some of these constructive filer things? And then if the answer to all of those is, nah, there's no hall pass, I've got to do the work, then you're going to be looking for either joint filing or the reduced filing requirements. And off you go, and you've got some work to be done. That wraps it up. We're at 56 minutes. I'm going to take a few minutes break. Next month, we're going to launch into Subpart F income, and we'll talk about that fun. We're going to take a few minutes break. I'm going to take a biology moment and then come back and launch into the Zoom. Again, if you want to participate in the Q&A, I'll be online in the Zoom room for half an hour and deal with as much as I can. If you didn't see the link in the chat field, then quickly just email me, Phil, Phil, at hodgen.com. There I am. And we'll get the login linky stuff out to you. All right. So I'll see you in about 5 minutes. And back to you, Jay. Thanks for listening, everyone. See you again. See you next month for Form 5471, Subpart F. Bye.